Hello, welcome everyone. Thanks for tuning in to our session. Some of you guys have been waiting on the YouTube live stream for a little bit, so sorry about that. Some of you guys are on the Zoom link. We're letting you in a sec. And so yeah, thanks for tuning in. We started doing these sessions a few weeks ago, and the general idea is that that we want to share a little bit of the knowledge that we have around all of this stuff, and hopefully turn into something useful for you. Sorry, I'm seeing the YouTube to my team, Julie. Oh, there you go. Webinar started. Okay, there you go. Sorry. Hello again. Okay, yeah. So let's talk about this process of pitching an AI startup to investors, because does that change? Does anything change of how you ought to pitch an AI company now versus a regular company? We'll see. That's what we're going to talk about today. So let me reshare some of my slides. I gotta have some slides, right? And yeah, so we'll have a bunch of time for questions. By the way, I don't have that much content on slides, and I love when you guys throw questions at me. Turns the session much more fun and interactive. So don't be afraid to use the chat. I have the YouTube chat here, and I have the Zoom chat here. Before the question comes up, is the session recorded? Yes and no. It's live streamed on YouTube on our Startup Club channel. So whenever if you want to revisit it, that's where you'll find it. Okay. So this number, right? So last time we checked, around $600 million had been raised with decks made with the help of Slidebean, right? But that's just a big sort of vanity metric, and I kind of hate it. We need to use it for marketing sometimes, but it's not the best metric, right? So what's up with that? Hey, from the Dominican Republic. Hey, back. Okay, so what's the problem with that? I remember this headline when it came out. I think we were raising our first pre-seed round for Slidebean. And I remember this app called Yo that raised $1 million. And all Yo did as a platform was send messages that said Yo. It was just literally Yo back and forth. No, it's no texting, just Yo back and forth. And this company raised $1 million. And I could not for the life of me understand how this seemingly shitty product raises $1 million while we were trying to raise, I don't know, 250 or 300, and we weren't getting any traction with our product, which is the whole presentation thing, right? And then you'll see the modern version of this is something like this, right? $800 billion for some company, or the Ilya, the one of the co-founders of OpenAI, raising $1 billion for this new firm that's just starting up, that has no traction and no revenue and nothing, right? So what's up with that? So the question is, okay, well, what the hell's going on? Why do these companies get away with raising all this money? And I have some stats to try and make some sense of this question. So the first stat is this one. This is a good real number. This is the monthly capital invested in startups. Ignore the last data point because that's just like an incomplete quarter. But this is the amount of money raised from 2019. So there was this wave. Notice that there's this wave there going on in 21, 22, where there was all this money in the market. This is stimulus checks post COVID, the world opening up again, and then a lot of companies raised a lot of money then, and then that well sort of dried out in 2023, 2024. A lot of companies went out of business because they struggled to raise money, and then this new uptick, right? And it's a clear uptick back in 24, 25. But there are some caveats to that number. Now, the first caveat is this chart that sort of overlays on that one, which is this is the deal count. So this is how many companies have raised money during that time. So you'll see that a lot of companies raised money in 21, 22, but by 24, 25, we're seeing the opposite, right? So the amount of money that's getting raised is growing a lot, but the number of companies that are having access to that money are fewer and fewer. So the first conclusion that we have about this current ecosystem is there's this idea of capital concentration, right? So more money is going to fewer companies. Let's keep digging. These are some actual good stats. So this is from PitchBook. This is the median deal size for each round of funding, right? So these numbers are a little bit hazy. This is a bad chart, honestly, but the numbers are there. So $900,000, that's your median pre-seed round, and $3.6 million yellow, that's your median seed round, right? So these are very, very big rounds. If you do the valuation version of that, so you're seeing pre-seed valuations at 8 million and seed valuations at 15 million, which is crazy, right? So a seed round, so a seed round of $3.6 million in my day and age, when we were starting Slidebean, that was like 10, 12, 10, 13 years ago. 3 million plus, that's a Series A round, right? And now a Series A round is $13 million. That's crazy, right? But that's sort of like the way of the market where these rounds are getting bigger. Companies need a lot more capital to get off the ground, and that's being translated into how big the rounds of funding are getting. So that's conclusion number two, right? These are huge rounds. Seed today looks more like a Series A back in the 2010s. But there are more insights here. So let's go with one more. So this other chart from JP Morgan is the median time, or the mean, which is the same as average, and the median time between different equity financing rounds for businesses, right? Latest data as of mid last year. But notice what's happening. This is a very clear trend from the average round of funding lasting 18 months. You've probably heard this number somewhere. Hey, you need to raise money for 18 months of runway. Not anymore. It looks like the new benchmark is companies are raising money for 24 months and sometimes more, right? Look at that average, right? More than 24 months. So you're basically raising these huge rounds with the premise that you're not going to be able to raise money for a while, right? So you need to collect as much collect is a nice word. Raise or yeah, gather as much money as you can now, get a big oxygen tank so you can go under and sprint on this product as much as you can. Why? And I think that the very direct reason to that is there's just so much competition in AI. So many AI companies are launching at the same time. Building a product got a lot easier, got a lot cheaper. Um, that the only way that you can stand out in this convoluted set of AI companies is, by raising a lot of money, right? Now, one thing that we've noticed with many of these, with these examples I've been giving you, is that there's something a bit like a wave. This, and we made this for one of the videos that we put on the channel the other day, but um, I think that this is a good reminder of sort of like how equity or startup funding operates. And you should keep this in mind whenever you're reading content online about how much money you need to raise or how to value a company, or it's not live like today. So like it might be outdated, right? That content might have been written at a very different timing in funding. I'm not going to go all the way back to the 2008, right? But um, just to give you an example, right? So we had a lot of round funding happening in 2014. After that, like the well dried out. This was like a Series A crunch where a lot of these companies that raised money, there was a lot of money pursuing very few ideas. So founders with bad ideas got money. That's basically what happened back then. And so a lot of those companies just couldn't raise the next one, right? Once you get institutional investors or once you're competing against companies with traction, the idea is irrelevant. Traction is what matters. And so a lot of these companies didn't manage to raise money. And so after that, 2017, 2019, we saw what we call the SoftBank effect, which is all these companies that, not all these companies, sorry, these handful of companies that got backed by SoftBank with, think WeWork with $20 billion check or whatever. No, it was like a billion. Sorry, I'm exaggerating. It's just a billion. These huge company checks, I think 40 billion was the valuation for WeWork. Suddenly, like investors figured, oh, well, maybe we should invest in these startups because they can turn into huge businesses, right? Look at the money that these companies are getting, not making, but getting. Um, and then I think that sort of peaked with this 2021 COVID mania, right? Like post-COVID stimulus checks, lots of money getting raised. And then the reset, right? Then this dry well, and then going back to the rerun. I don't think that we're at the peak of this new round, but that's just my thesis. Don't take my word for it. But the point is, there's a good chance we're going to hit a peak of AI funding. Funding's going to dry out for a while, and then you're going to have to, and then companies are going to struggle, and so on. Like that's just the way of startup funding, right? And you can sort of see that wave here. I made that up, but this is not this I didn't make up. This is an actual chart I stole from someone. This is called the graduation rates, right? That's the amount of companies that raise the seed round and then raise the Series A, right? So notice again that Series A crunch around 2022, the post-COVID mess, and now like a bit of a rebound, right? These companies that started raising money in 2023. Today, like it's not an apples to apples comparison, but the graduation rate today is about 15%. The number comes from another source, so I don't know if it's an apples to apples to this chart, but it's kind of like a slower hill, and I don't think it's because there's less money. I think it's because the handful of companies that are raising money are fewer, right? It's fewer companies raising much bigger checks. But these are the conclusions. Like that's kind of like the world that we live in, and we can't forget about that if we're intending to raise any money for our companies, right? So just keep all those in mind. If we were to rearrange this in some other way, um, to me, it would look something like this, right? So more founders are competing for a few larger checks, and they're raising extra money to be safe in case there's another crunch soon enough, which there might be, right? Okay, this might be a good time to a break for questions. I get the question sometimes that is this live? Is this live? Or is this a pre-recording? Yeah, it's live. I see you, Eric. So in this fast era of AI funding, is there a scope of bootstrapped companies getting successful or getting big? That's such a good question, man. I have notes on this and some slides that will partially answer this question. Um, I think that a lot of bootstrapping, like at bootstrapping, you should bootstrap as long as you can bootstrap, right? Bootstrapping is great because you don't have to deal with investors, you don't have to raise money. Raising money is a huge waste of time because you have to like the founder will need to step out of their role for 3 or 4 months at least. The round will take about 6 months to close, but it's basically, you're short one team member that's fundraising instead of working on the product or working on marketing, which sucks for any company. Um, so if you can bootstrap, then bootstrap. But at the same time, caveats, right? Bootstrap will mean that you'll grow slower. And maybe today is not the time to grow slow, right? In this day and age, right? Because at some point in the 2010s, like it was so much about who can raise the money or who can find the funding and the team to build this product, which will take 2 years or a year to build. But now you can build and launch products a lot quicker, weeks, days, right? And you can answer a lot of questions and validate a lot of stuff. Your product can also get ripped off much quicker, right? If you have a good product idea and somebody else looks at it, right? That doesn't happen very often, but point being, there's a good chance that some other company came up with the same idea as you did in the world. That always happens, and whoever launches first or whoever gets traction first wins. It's not the best idea; it's the best execution. And so when you're bootstrapping, you are at a disadvantage, right? Little side story: we at some point we tried to build this product called Recurring, which was like a SaaS tool tracking. We spent a lot of money on SaaS tools, so we wanted to build this little dashboard that kept track of it, and we figured that we would share this product with the world. And so we started building it like with in our spare Slidebean time, right? We had an engineering team, and we all kind of pitched in and used time to develop this product. And then like 3 4 months in, like three of the same product launched, and these three companies were venture backed, recently venture backed, so they had a big chest of money, to spend and to grow. And we figured that we would stop, right? Why? Because we were bootstrapping, right? We were using this, we were focusing on our core product and doing this one on the side. Um, but we were not going to win this race because they were venture backed. They had more money than us. So there's always a caveat to bootstrapping too. Steve, is there a point where racing at too high of evaluation actually hurts a startup later? Yeah, it happens. Sometimes high evaluations, can backfire. I have a slide that will explain this better. So I'll touch on this like literally in my next slide section. Suman Company sorry, Matt. Suman Company has a novel idea and they've been bootstrapping it for a few years, but now capital is the limiting factor. Would you suggest simply skipping seed? Yeah, I would. I think that's fair. Hmm. We're going to talk a little bit about stages of funding. Like normally, um, a seed round you would raise when you have 40K of revenue at least in this product and you're growing fast. So if you're growing slow but have 40, 50K, maybe you could play the card of a seed round. Um, Series A's are $2 million in run rate or more. So like if you're not there yet, then you're probably gonna have to struggle a little bit with those conversations. What MRR range are you actually seeing when you close seed rounds right now? Jenna, yeah, I think it's 30 to 40K in monthly revenue and growing, right? And growing fast. Um, Here, Yannick, the last question, and then I'll move on with my slides. We're building an AI video editing platform with some traction, and when talking to potential investors, we said we were raising 500K, and they actually told us that it wouldn't be enough. Yeah, that's actually exactly right. Right, like 500K is not a lot of money today, and again, the median pre-seed round was $900,000. So, 500,000. What you don't want to do is you don't want to get stuck between rounds, right? You don't want to be between one round or the other because that normally it backfires a lot. But okay, let me go to some slides and we'll have more time for questions in the next little break. Okay, so one thing that I want to distinguish, and I came up with this little slider the other day, and I think it's useful to understand the AI part of this equation, right? So, well, are you an AI company, right? Like how does that affect your valuation? How does that affect your how much money you can raise? I guess to your question, Raffaello. So let's see what a normal versus a tech company was. Um, and this is the 90s, right? So in the 90s, Amazon, right? Amazon was a venture-backed, backable startup, right? If you wanted to build an e-commerce, Boo.com and all these like dot-com bubble companies, these are e-commerce companies, right? And these companies were raising rounds of funding, Series A and all of these rounds. They were raising good bucks to build. Why? Well, because if you wanted to build an e-commerce in the 90s, you had to rent out some data center, build a server rack, like own some servers, and find like a guy that whose job was to maintain those servers and keep them alive. Um, that's all that you needed to spend all this money to build an e-commerce back then. But now, well, e-commerce is kind of commoditized, right? Anybody can build an e-commerce in 2 days. You can just use Shopify. It's all built for you, right? So e-commerce businesses are no longer venture backable, or they rarely are, unless they have some really, really insane traction, or they've accomplished some very novel thing. A Shopify store doesn't get venture funding, right? Not tech, or not. It's not considered a tech company. Yes, you are using technology, but you're not a tech company, right? So what about AI companies now? So what does this do, right? I also kind of like to think of make this distinction. Like this is a fast forward to somewhere around the 2010s, right? Around 2015, when say OpenAI got created or founded. Back then, right, if you wanted to build an AI business, right, you're literally coding a new LLM. You have scientists and PhDs that are like developed, like hands, heads down. They're not looking for revenue after pre-seed. They're not looking for that 30K MRR milestone. They just need money for research. They're just going to build this deep product that took them years, right? Years of R&D to build these transformer models, papers, scientific papers published around it. So that's what I would call like a proper AI company, right? But now um, there are other AI companies that could also get the label, right? Because if I have a SaaS business that I'm building over, that I'm using AWS, I didn't buy my own servers. I'm using some APIs and some existing libraries to build this product. So I can build it and ship it quicker, and then I hook up to OpenAI's API to do some AI automation. Am I an AI company? Well, yes, I think you are. You get the right to call yourself an AI company if you're using AI, but these are not the same, right? These are both AI companies, but they're not the same, right? So we need to make that distinction when we think about fundraising and when we're looking at rounds that these companies are raising, right? So if you're building a software product like a SaaS that is using an existing AI API, you're just a usual SaaS company, tech startup that uses AI. Yes, you can say you're an AI company, but it's not your proprietary AI. On the other hand, there's you still have the big leagues, right? The AI companies, the R&Ds, the former OpenAI co-founder raising $1 billion. You still have those R&D startups that are looking to now compete with these large models that have where these Microsoft and OpenAI and Google, they've all spent billions of dollars developing, right? So like if you want to play in those leagues, you need to come up with a there are absolutely PhDs in your team, and you've come up with a new, much more efficient way of doing this advanced stuff that these companies are doing. But again, these companies are not created equal. For this second company, they're going to spend years developing this and many millions of dollars accomplishing, and maybe they will, maybe they won't. But these other companies, right, the software products, traction is absolutely everything. There is no chance of, as things get much more competitive, traction becomes so crucial because it's the only way you can stand out from the hundreds and hundreds of companies that are launching all the time. Okay. Now, with that being said, let's go back to the topic of today, which is pitching, right? Let's talk, how do we frame this pitch, right? I mentioned that about $600 million worth of funds have been raised with pitches that we helped build in some way or form. And for the longest time, we had this, we had a service, an agency service that redesigned decks. We still do, but it's a much smaller operation now. There's AI now, and we still do a little bit of deck writing, right? So a lot of companies would come to us um, with, hey, like I want to frame this story in the best possible way for investors. And every single company came with these exact same problems, right? And kind of like the work that we wanted to do, which was just, hey, let's just capture this story into a deck, became you have very wrong assumptions about these five things: TAM, go to market, financials, valuation, and the amount of money that you're raising. That consistently, right? We saw founders struggle with this. Um, and in the end, the idea of a pitch deck is that a pitch deck, when you're trying to pitch your company, in the end, what you're doing is you're just telling a story of what your business is, right? It's a story that's wrapped with numbers, of course, traction. It's a story about the product and the tech that you're building, and it's a story about founders and people, right? So if you wanted to put that into one word that you can steal and screenshot this slide, it'd be something like this. Like a pitch deck is a company story of what the company has accomplished so far and the vision for what this company can become. Okay. Um, in that cycle, in that deck, you want to answer one extra question, which is, okay, well, how are you going to get there, right? How are you going to scale this business? How are you going to accomplish this, right? Now, a related factor with this is that, a lot of companies just get to try to pitch deck, sorry, get to try to pitch their companies and get to try to get in front of investors. They're not actually ready to do that. And I'll ask this question, like, is your company ready to raise money, and are you sure about it? And I'm going to paint these two scenarios. This is the long-awaited answer to one of your questions. Two scenarios on companies and valuations happening today. Let's take company number one, right? So company number one is looking to raise a $1 million round, which is not a weird thing in this day and age, right? It's a normal pre-seed round. And this company is thinking of, say, okay, like we'll raise $1 million and we're willing to give investors about 15% of the business. We read about it somewhere that these pre-seed rounds are translating to about 15% equity, right? That's like a $7 million valuation, something like that. Yeah, maybe 7, 8. Great. So that's what we want to give investors. Okay, and what's going to happen with this money, right? What's going to happen? What are we going to do with this capital? Well, investors are going to get 15%, and we're going to use this money. We're going to grow this business. In a few years down the line, this business that we're working on is going to become a $10 million company. That's a shit ton of money, man. $10 million business annually. Great. It's no, I mean, I'm not being sarcastic. It's just a small feat. I mean, it's no small feat. $10 million in revenue is a shit ton of money. But there's a big but with that. If your focus is getting this revenue, right? The typical company that makes $10 million, might have an EBITDA, that's your earnings before taxes, of about 10%. That's pretty standard. That means that from this $10 million in revenue that you made, you get to keep 1 million, 10% as profit. And then, of course, on those profits, you have to pay corporate taxes depending on where you are. Let's say that you're in the States, maybe that's around $200,000, 20%. Okay. And so from those $800,000, you'll take, if you decide, and you don't have to, but if you decide to pay these as dividends to you and to investors, sorry, to your question, what's TAM and DTM? We'll get there, no worries. If you decide to pay this these dividends to investors, these $800,000, because investors own 15% of the business, they're going to get about 120,000. Okay, it's not bad, but they invested a million into your business, right? So how long will it take them to recover the million? Well, by that math, it's going to be about 9 years. And they have to pay taxes on those dividends too, right? That's a whole other story. But 9 years? So from $1 million round, 15% of the company, investors need to wait a few years until you make 10 million a year. And then after that, 9 extra years to get their money back. That's not that's not very exciting as an investor, right? It's too risky. This company might go out of business and I might not get anything back. I'm not an investor. I'm just pretending to be one. But yeah, so this obviously doesn't work, right? So that's why, when I ask, is your company ready to raise money? Are you thinking correctly about the way funding works? Because funding in reality for tech companies kind of works a little bit like my example, company two, right? So what's company two? Well, company two, again, needs $1 million. They're willing to give investors 15%, but they're not going to focus on profits. They're not going to try to get those $1 million, 10% EBITDA like before. They're just going to focus on growth, growth, growth. So they're not going to be profitable. They're going to be so unprofitable that they're going to need another round of investors and then another one, right? So these investors, the first investors that came in, might have had 15% at the beginning, but because all these new rounds of funding came in, their shares got diluted and the founder shares too. But everybody's shares got diluted because we have more people on the table. 10%. They're down to 10%. But because this company has so much money, they have such a big oxygen tank, they can go and outcompete everybody else, right? They're not focused on profits. They're just reinvesting everything in building the product and growing and marketing. And so they get to 10, not to 10, but to $50 million in revenue. No profits. They're unprofitable. They lose money every year, but they make $50 million in revenue. So what happens with this business? If this business plays their cards well, they could very easily uh, be acquired. So they might be acquired by a bigger company, right? This larger entity might come and buy them out. And it's not crazy, and I'm not making this up. It's not crazy to see a 5 times revenue valuation. If you have a growing business, maybe regardless of profits, it's a growing business. There's some good technology there. Maybe it's a competitor to you or very complementary software to what larger companies are already doing. They might just acquire them. They just buy them out. So 5 times revenue, $250 million paid out. So for this investor that put in a million, their share is now down to 10%. They're still getting 25. They've essentially multiplied their money by 25 times in a span of what, 7 years, 9 years that a startup takes. That's the game of venture capital. It's not profits. It's not a little bit of ROI over many decades. It's a very large multiplier over a short amount of time. And of course, this is super risky. You're going to need multiple rounds of funding. You're going to need to grow really, really fast. You're going to need more investors to get there. And the only way you can pay these investors back is if you actually sell the business, right? So that exit is a requirement. But back to my original point is like when I ask you guys, are you ready to raise money from tech investors? The big question is like, this is the path that you need to sign up for. There is no raising money from venture capital and then becoming profitable and then owning this business forever and leaving it to my children. That's not the way venture capital works, right? So going back to this pitch deck question, it's like, okay, it's a company story about what the company has accomplished, what's going to become. Very important how you're going to get there, right? The story of your traction, of your team, and your scale, and of course, how much money does that mean for me? And again, hypothetical me, if I were an investor. Um, okay, I see a question here in the chat. Maybe a little time for a break for questions. So I'm a one-man band with a patent pending on a cooling data center system. Realistically, how much in seed money should I raise? Man, like I think that solo founders struggle to raise money. Like normally, and patent pendings are still also not, patent from a patent pending to a patent. There's a long, long road, long expensive road. Um, yeah, so like I think that you need to decide like, what's the game here? Are you going to manufacture and build this cooling data center system solution that you've built? Um, sorry, train of thought. If you're going to build it, then you need a team that can build it, right? It's not just you, the inventor, but I don't know, the operations team and the design team and the hardware team and whatever. So that you need a team around that if you want to raise a seed. If your game is, I want to have this patent and license it, maybe I'm not the right person to ask. Usually I'm in the building, right? Normally through universities, you can, these larger companies sometimes discover these patents and license them, but it's a very different path, right? And not usually a venture backable path. I think the venture backable path is the company, right? You may have the patent to protect you, but the company building things is the thing. To your question, on the slides, I don't share my slides. They're mine. No, I'm kidding. This is live streamed on YouTube on our Startup Club channel. I'm gonna paste the link because I have it right here. So if you need to revisit, it's all gonna be there. Okay. Is there a reasonable expectation of team size relative to the money being requested? No, I don't think so. I think that the team size at any stage is just, whatever team is necessary to get to the next stage. So no, I don't think there's a ground rule on team size. Okay. Okay, so let's talk about how to relay this message, right? So how do we get this message to investors as a company? This is what, again, let's go back. I'm gonna go back one. This is what we're trying to answer, right? How are we gonna get there? What are we doing? What's our vision? How are you gonna get there? And how much money are you gonna make the investors? And I'm gonna rephrase that into even more concise questions. 4 questions. Question number 1: what have you discovered in the market, right? What problem, painful thing, data center cooling, or taxis suck, and that's what prompted Uber. What have you discovered? What pain point have you discovered in the market that is so painful that people are willing to go out of their way, sign up to a new product, or pay more, maybe less, but or change something about their behavior to because the way people are doing this thing now is just shit, right? Whether it's businesses or end users. What have you discovered, right? Um, Next question. Um, what have you built to tackle it, right? What is this product that you've built, and who adopts it first? Those are 3 questions, but it counts as one. Um, how much, and then how much are you growing, right? So how much are you growing, and how much are you going to continue to grow this product, this business, over time, right? So that's the answer to how much money you're going to make the investors. And then the last question is, why are you and your team the team that might change the status quo? These are the 4 questions, 4 core questions that a pitch deck must answer. And pay attention to my color coding. I like colorful decks. So this color coding we're going to use as I'm going to walk you through some good examples of these slides. And another slide that you want to screenshot maybe and steal. I mean, this is a good slide. Screenshot it. Take it. 3, 2, 1, go. Okay. And this is the other one. As you translate those into a pitch deck, like that sort of becomes the sections of your pitch deck. Those 4 questions, we're going to answer them in 4 sections of the pitch deck. The status quo, that's your problem slide, your business opportunity. What have you discovered? The solution, well, that's your product samples, your demo, your case studies, a little bit about the target audience, the pricing of the product, right? That's you're talking about the solution. It's the part that founders often struggle with the least because everybody likes to talk about their product. Next up, the market, right? That's to the question that came up earlier. Go to market slide, traction slide, total addressable market, TAM. All that becomes in the market section. We're answering the question of how much money are you going to make the investors? And then to wrap it all together, right? That's that last yellow section, the why us, is about, okay, here's this opportunity we discovered. Here's this product we came up with. Here's how much money could be made with this product that we built. And here's why we are the team to do it, right? I mean, once you zoom out, like sometimes people like get stuck in one slide and just trying to solve it and design it. But if you just take 2 steps back from your laptop and look at your deck and the structure of your slides, like are you answering this set of questions for your potential investor, right? Are you getting them excited about what this is? And so let's look at some examples. By the way, before I look at the examples, we have 2 useful tools for this. Well, first of all, this template, any template on our platform, Slidebean, which you can find at slidebean.com. My team will paste links in there. Any template sort of follows this structure because it's the best pitch deck structure. We didn't make it up. We sort of distilled it from a bunch of examples like the Uber deck and Airbnb deck that are some of my favorite pitch decks out there. So, any template that you use from Slidebean will follow this structure so you know you're on the right track. You can sign up and it's free. Um, and second, if you already worked on your pitch deck and you're using not Slidebean, we'll forgive you. We have the pitch deck reviewer. So this is an AI tool that we built that will give you like a summary of feedback slide per slide and the overall structure of the deck on whether you're missing items or whether your slides are too crowded or whether you're achieving this objective of getting investors excited about your product. So links in there for the pitch deck reviewer and the and our Slidebean platform. I think pitch deck. I think that sorry, I think we got the wrong link. This is the right link. I'm sorry. Dropping it there and dropping it there for you guys in the chat. Okay. Okay, so let's look at some slides. Oh, the pitch deck reviewer is free, by the way. If that wasn't obvious, it's free. You get 2 completely free reviews on once you submit them. Okay. Let's look at the slides. Let's look at some slides. I picked for today 11 Labs, one of my favorite AI companies, and I know that AI gets a lot of hate on YouTube. I'm sorry, on YouTube and in the world. Sometimes people are hating on AI, but I think 11 Labs is actually a really good company, and it's the premise of what they're solving is actually pretty solid, and I really like it. So let's look at what they have. Okay, so we have the intro section. That's the cover, the traction teaser. Sometimes I like to put a traction teaser in there, which is kind of like a slide that teases or that gives the investor an advance on how fast this company is growing. Remember, this is the second slide, so they don't know what you do. But if you have a slide in there that says, hey, we're growing 20% every month, it's like, oh, holy shit, I need to go and see what this company is all about. If you don't have traction, if you have 100 beta users, that's not worth a traction teaser. So no need to include it. Very optional slide. Okay, but not much else on the cover, right? We can write a cover. Okay, first section, status quo. What opportunity have you discovered in the market? Right, so we said that this section might include slides like the problem slide and the solution slide. Sorry, not the solution slide. Solution comes later, but the point is that the problem that you present in this section is what the solution slide answers, right? So we present a problem, here's this business opportunity, and then our product solves it. And they sometimes kind of look a bit like a mirror of each other. So let's look at 11 Labs. 11 Labs has this slide, which is, they call it introduction. I consider it kind of like a market overview slide, which is, well, if you're an outsider to this world, let me get you on the same page as we are. How do podcasts and creators translate stuff, right? Well, they have to hire a dubbing agency. It's about $100 a minute pricing. It's this long 2-week process, which delays the whole thing. Like, there's just, again, there's no problem out there. It's just like, hey, this is just how the way the world works today, right? For dubbing. Okay, so now we go to the actual problem slide. And man, this is one sentence. I've seen problem slides with like 5 sentences and all these bullets and things. Look at how simple this is. There are no affordable tools to make content watchable in any language with high quality. That's all you need. That's all you need. That's the premise of 11 Labs. That's why they're a unicorn now, because the premise is very simple. And notice how this starts to hint a little bit of what they're doing. But if you don't know what 11 Labs is, you sort of kind of inferred it already, right? With these 2 slides I've given you. It's AI dubbing, right? Something along those lines. Because why? Like we've established this problem, but notice that this problem slide has some context, right? And here, we're thinking, okay, like this is for people who create content. But is this film? Is this creators? Okay, we don't know yet. But affordability is a factor, right? An affordable tool to make content watchable in any language with high quality. Okay. Let's go to the next section, right? So we've established the status quo, we've established the problem. Now let's go to the solution or to the product section, which is, again, answers the question of what have you built to tackle it? How does it work? Who is it for? And slides that come in here, I'm not going to go through all of them, but solution, product, features, how does it work, the business model, the roadmap of product building, like all of those stuff, all of those things normally belong in this product section. But okay, let's look at some slides. Remember, like this idea of a mirror, right? We established that a few slides back, no affordable tools to make content watchable in any language. So if you go forward, it's like, okay, human quality, automatic or automated dubbing as a SaaS. And then they're talking about human quality, personalized, and simple and quick, right? So they're sort of answering those questions. right? It's quick, it's cheap, it's human quality, right? We've answered the problems that we presented in the problem slide. And notice that in this solution, we haven't really seen the product yet. We don't know how it looks. We don't know how it works. We're not trying to stuff all this information into a slide. We're just presenting our thesis. Like, what if we could build, what if a company could build this product? Okay, so let's look at what comes next. So next up is a demo. I'm not a big fan overall of demos, live demos or videos, in part because, a lot of investors consume their on pitch decks that they get on the phone. So they might not click on a video. They might not hit play on a video. So like that's, you're not guaranteed that they're going to see your demo. So if if you can demo your product with screenshots, I would much rather that, right? Because you can show them, people can just look at a screenshot. Oh, I see how it works now. I had an idea about it after seeing the solution slide. Imagine how the product could look, but now I'm getting a picture of it, right? So it's okay. Okay. So I can understand how it works. With something like 11 Labs, of course, they're trying to prove that their voice dubbing is human quality, right? So, so they need a video. They need something, and I think that anybody would have asked for that. To your question, Yannick, does it make a difference if you create a pitch deck to send or to pitch in person? Absolutely, absolutely. Uh, Most people like end up working most of the time on the pitch deck that they'll send because the reality is that most pitch decks get read async, right? So somebody gets a pitch deck on their email, they read it, and they return the call not the call, they schedule a call with the founder if they're interested, right? That's normally the way you do it. You have demo days, for example, or you have meetings where you might bring a pitch deck, for example, a pitch deck for demo day couldn't have this slide. That's just too much text if you're standing on stage, right? Nobody's going to have time to read, or they're going to read and not pay attention to you. So that's a very different case. Normally, and I like to divide them into three. I like to call them the email deck, which is what you should be spending most of your time on because that's the one that most people are going to see. The meeting deck, which to me is just like the email deck, but with a couple extra slides for extra context. And a demo day deck, which is very different, right? That's more like a showman sort of pitch deck. Okay. Uh, Next up, vision, right? So this is also in the product section, right? And this is sort of an I don't like the title vision, by the way, for this slide. I would have called it audience. Um, yeah, target audience, I think would have been good. But it's very clear, right? So 11 expansion, notice how 11 started down here and is moving up. And what they're telling us is like, well, we think that this automatic dubbing for creators is gonna work. And notice that it's an initial focus. It's tiny. Again, it's not a deck that you could put on a stage. It's very much something to be read. But yeah, initial audience, YouTube, Twitch, uh, Final Cut, people editing, right? People editing or podcasts and so on. Creators, which is I guess me too. But my videos are 25. I can't pay 25 minutes now. I can't pay $2,500 to have a video dubbed. I wouldn't do that, right? No, a creator could not afford that. But if it's auto dubbed and that gives me an expanded audience, fine. And I have to pay, I don't know, $10 to do that. Fine, I'll take it, right? So there's a very clear value proposition for a very specific audience. And of course, the product today, you couldn't use it to dub film, right? And I guess people would write a little bit. They're thinking real-time dubbing in there, so that's interesting. Like they're trying to mix, I think, two things in this slide, and that's why the title is weird because they're thinking roadmap. It's like, okay, here's what we're going to build, and they're also thinking audience, right? You could perfectly split this thing into two slides, but this is a good slide. It gives the audience context of what they're trying to accomplish. This is the deeper version of that. Content creators, right? I think some market validation here too. Mr. Beast has this is old, but Mr. Beast used to have 20 million subscribers on the Spanish channel before dubbing was implemented on YouTube. So he had a separate channel for videos in Spanish and in a bunch of different languages. Now they're all unified, but that's the point, right? There is a demand for this content, and creators would adopt it if it's good and affordable. Again, more validation on the product. I'm sorry, on the audience. Next section. I mean, I didn't do all the slides, right? Remember, there's business model, there's roadmap. We talked a little bit about it, but other slides fit in the product section. I normally don't stop too much because you guys can figure this out. Like talking about our products is usually easy. So next up is going to be the growth. I'm sorry, how much money you're going to make me section, right? How much you're going to grow, how much you're going to continue, are you going to continue to grow? So let's look at that. Yeah, the slides that normally fit here are traction, go to market, and market size. Traction, you know, remember stages, right? I think pre-seed companies don't sorry, camera. Yeah, pre-seed companies don't need traction in the form of revenue, but they need traction in the form of we've talked to all these customers that we understand. We've validated this product. We have letters of intent. We have X amount of beta users on this little mock-up that we built, right? So traction isn't always revenue. If you're raising seed or later, then traction is revenue, and you need to show a good revenue slide. And don't try to cheat on that by putting your cumulative revenue or some shit like that. And just give us month-over-month revenue. This needs to be a lot of revenue. It needs to be growing revenue. That's what a seed, I mean, that's what the expectation is at seed and later. Go to market slide, very often overlooked. That's the GTM slide we were talking about earlier. Any deck, right? If you're raising a pre-seed round, the money that you raise needs to get you to seed, right? You raise money from one round to the other. And seed is a round that you raise when you have 30, 40K in monthly revenue, right? So the answer to how you're going to get those customers is always a question that a pitch deck needs to answer. At pre-seed, it's like, how are you going to get to 40K? Because this money that you raise now is what needs to last you until you get there. And then for seed and any round after that, of course, right? You go to market. How are you going to get customers? So go to market slides are not a list of ideas. They're not a list of, oh, we're going to do social media and SEO, and we're going to do AI optimization, and we're going to have a YouTube channel and do influencer marketing. It's not just a list of marketing tactics. It's like, what specific thing are you going to do that is going to make you stand really far apart from the noise of all the tools that compete with you? Very crucial. And then finally, the market size, which I have some comments on. So this is a great example of a really, really good market slide, where notice that here 11 Labs is a dubbing platform, right? They could have said, oh, Hollywood spends $4 billion a year dubbing videos, and that's our market. And it's like, well, I mean, it might be someday, but it's not your market today, right? We don't know if 11 Labs is going to accomplish that even today. So notice that their TAM, their total addressable market, that's the TAM acronym we said earlier, is 50 million content creators worldwide, right? A bunch of people upload shit to YouTube now. But that's not who they're gonna really monetize. That's not what they're basing their big business on. They made a smaller dent in that market, which is professional creators, people who actually make a living from YouTube. And even then, they're not assuming that they can get all of them, right? They're shrinking that one level down, and they're saying YouTube creators with 500,000 subscribers or more. That's what they call their obtainable market, right? That people who might buy this product. And if they charge what's that? 9 million minutes per month? Oh yeah, 9 million minutes translated per month, then their revenue would translate into this. Why? Because they're taking in their rate for translating a minute of content, etc. So the clarification that I want to give you guys here is like, content creators worldwide is a fair way to say TAM. All the dubbing market in the world is not the TAM of 11 Labs, because that's just too big, right? It's not everybody. And again, what they're doing is they're taking this subgroup of the subgroup and saying, can we get are all of these people our customers? Yes. Right? That's our audience, and that's how big our company is going to get. But remember that the question that we're trying to answer in this market slide is, how much money are you going to make the investor? Which we have answered now with, well, I mean, not us, but 11 Labs. They've just told us, just with the creator aspect of this product, we could make $110 million a year. And that's before we tap into more professional creators, because that's an even bigger market, or before we move, sideways to say Hollywood or, cheap TV or whatever stuff supports AI dubbing now, before the product gets to the point where you can go to the Hollywood big dogs, right? So that's a really, really interesting way of looking at it. So that's why I always like to talk about this 11 Labs example. Okay, last slide before I go to last round of questions. Why are you and your team the team to make the status quo? That's where you talk about competitors, competitive advantages, and team. You think of this arc, this story arc that we've put the investor through. We found this big problem in the market. We built this incredible solution. Look how much money can be made here, and here's why we are the ones who can make this money, right? So, in competitive advantages, it's not so much about laying out competitors. 11 Labs did this little chart thingy, like the Steve Jobs chart. It works sometimes. Just try to keep the axis simple, right? So notice that there's one variable, human quality, and no, actually three variables, which makes it kind of confusing. Human quality and let's say speed, right? So like that's as long as you have that, because sometimes people put, I don't know, speed on the left, and then they put, I don't know, price on the right, and that's those are like not the same thing, right? So be careful with these two axis charts. They work, but in the end, what you're looking to accomplish with this slide is saying, here's what we understand that competitors don't, right? IBM, IBM Watson could perfectly dub products, but it's not built for creators, right? It's not a easy to use interface for creators. You need to put in some coding in there, right? And obviously, human quality exists, but that's the manual process. So we can clearly see how 11 Labs operates in this empty space, or at least they did when they started. Yeah, some deeper on competitive advantages, and again, team at the end. Sorry, I think I duplicated this slide. Anyway, that's the startup journey. Last but not least, financial projections, how much money you're raising. I'm not saying this is irrelevant. I'm saying this is not a story as much as doing your homework, right? This is your homework of actually figuring out how much money to raise, doing the math, and proposing terms and for the investor that are exciting. Okay, we're gonna jump to questions. Last commercial. The reason why we do these sessions is because we can help with all of these things. Our platform Slidebean has tools for all of this, and again, it starts free. A lot of these tools are free. The base plan is just $12 a month, $8 a month if you pay annually. And it includes an AI pitch deck builder that has all of these tools and these templates and this structure already baked in. We have an investor finder with over 25,000 investors. We have a cap table tool if you want to estimate how much you're going to be diluted by different rounds of funding. We have a financial modeling tool so you can forecast your revenue and your costs to make sure you don't run out of money. And probably a user favorite is that some of our subscriptions include monthly one-on-ones with my team. So, for example, the Accelerate plan on Slidebean includes one monthly call with our pitch deck team, one monthly call with our financials team, and two calls with me, with yours truly. So we do one right after you sign up, which is a small group of 5 people to kind of get early questions and kind of like get a sense of kind of like a work plan for the next few weeks. Then you go on with my team. You work with the pitch deck. You get reviews. You get your financial model assistance. We help you build that. We have bootcamp in there. And then after that, I like to connect with founders once again, once they're ready to go start pitching investors. And then we can talk a little bit more strategic and other deeper questions about philosophical questions about running a startup. But those are all my slides. Now we can jump to questions. Okay. Yeah, links dropped in both chats. I'm seeing more questions on the recording. So we're live streaming this on our YouTube channel. I'm gonna throw that link once again. So if you need to revisit these slides or this content or my commercials or my dad jokes, that's where you can find them. Okay. Yeah, I see Q&A, so let's go. I'm going to take one from each side. So pre-seed, do you need revenue, and what would be the traction they're looking for? Sorry, no, you don't need traction at pre-seed. Maybe I already answered that. So we got it. Okay, I see you on YouTube. Help me understand Indian pre-seed market. I followed Slidebean pitch deck, but everybody says it's not enough. I've used AI and internal data to understand this, but still not enough. I mean, not enough is a very abstract answer to this question. Is it not enough the opportunity? Is it not enough the business plan? Is it not enough your ability to sort of convince an investor that you can accomplish this? Is it not enough in the sense of, are you not proving that there's enough of an opportunity, or maybe the team doesn't have enough experience to accomplish this? Like, not enough. An investor not saying not enough is, you try to ask a follow-up question to that and see if you can find what the not enough meant, right? And that usually helps. Question on Zoom. If we upload our business into Slidebean, How is it protected as far as being secure and not stolen? I guess I'm asking this the right way. Oh, we have. You can check our privacy policy and terms. We've. I'll give you. I mean, we obviously have legal protections and security and all that stuff. We don't look. We don't look at pitch decks unless you give us permission to. But more importantly, we launched Slidebean 13 years ago, and I'm still doing just this thing. And I haven't, I think maybe a million pitch decks have gone through our platform at this point. I haven't stopped what I'm doing to build somebody else's company. So not nor have any of my team members. So no, that's not. We're not in that business. I'm using your investor finder. What's the best way to contact them cold? Great question. So thanks for using the investor finder, Vincent. So with investors, I think a lot of people make the mistake of assuming that the path to find it to an investor is through a cold email. We actually used to give investors emails through our investor finder, but what we found is that they would just export a list of emails and email blast an investor, or I mean 100 investors with their pitch deck. That's not the way you do it. The way you find investors is you go to their LinkedIn profiles, which is what we give you in the investor finder, and you filter them, right? You can filter them by region and by stage and by industry. You find the investors you want, and you do this command click, and just open all these LinkedIn tabs. When you're trying to find what these LinkedIn tabs is, which investors are somewhat connected to you, which investors share a second level degree connection to. We're trying to automate this, by the way, but it's not easy to build a LinkedIn integration that would allow you to check for connections. We're trying, but the whole idea is that, right? It's like, uh, can you build can you find a path, a network path to each investor? If you don't find one to any investor, right? First, weird, right? There are thousands of investors in there, right? So there must be someone. And if you don't find one, then maybe you don't have maybe your problem is a little bit of a network problem, right? I had a network problem. I didn't know a lot of investors when I started building companies, and I had to level up. And to me, the leveling up was accelerators, right? So startup accelerators became a bit of a network fast track, right? If you grew up in New York or in San Francisco, well, you probably know people who know people. It's going to be easy. But I grew up in Costa Rica, so I don't know a lot of people that know people. So yeah, you can use an accelerator as a bit of a bridge for that. Whoa, bunch of questions. Hold on. I'll try to be faster with my answers now. Why do VC capital always ask for traction before investing? No, traction, I mean, again, traction is not always revenue, right? Traction is we have a team, we've validated this problem, we've talked to customers, and yes, ideas are not fundable. An idea stage company is not the same as a pre-seed company. A pre-seed company has done good work. They've spent months cooking this idea, testing the product, talking to people, or testing if the product might work. It's not revenue, but all of these things I just said, talking to people, validating the product, checking if it actually works, doing mock-ups, you don't need a lot of money for that. You just need time. And investors expect you to have invested that time before you go talk to them. When talking about traction, what is the standard for enterprise pilots? Can they be free, or do investors expect paid traction? Good question. Yeah, I mean, I think that oftentimes enterprise startups are able to get the companies that they're working with to pay upfront. I think that happens. I've seen it. It's sort of like the best proof, right? If you're doing a pilot that's going to cost you, the company, so much time, right, and so much effort, then it's almost expected that the enterprise will pay. And also, for enterprise, $100,000 in this paid pilot is honestly not a lot of money. But it proves that you were able to sell. It proves that they might be interested in this thing because free is nobody pays attention to free stuff, right? Free pilots, people don't prioritize them. But if you actually put your money where your mouth is, then I think that makes a difference for investors too. Quang, I don't really need the money because I'm not on my way to get 200K a month, which is suitable for Series A, as you said. I do a strong seed round or try to go for a Series A and skip seed round. We have two founders and haven't taken any VC funded. Holy shit, man. Congrats. Congrats. I would just raise a Series A to your question. If you can skip seed, you bootstrap all the way to Series A, you've basically skipped two dilution rounds compared to your next guy. Yeah, so like I would raise Series A kind of money at that point if you have them. I mean, it looks like you have the metrics. Assuming this is SaaS and scalable. I mean, not SaaS, but technology, scalable, etc. Um, how does venture capital fundraising work for startups that are not based in the US, particularly founders building companies in Africa? I'd say that you need to raise money in your turf. I think investors often invest in their turfs. I see a lot of companies trying to pretend to be US companies by just like registering a Delaware C Corp, but their market, their customer base, their team is based somewhere else. That usually doesn't play, right? You raise money in the market that you target because investors understand that market. Investors can see that you understand that market better than anyone, right? And that's the premise, much more than where your company is registered. People think a lot. It's there's a lot more money in the States. I mean, there is, but if your business doesn't target the US, then yeah. Quick fire on the last few questions. Do you need an advisory board? I'm not a big fan of advisory boards, so I don't think that you need one. It's useful if, but I wouldn't. Also, usually don't recommend putting it in the deck. They help, but they're not. They don't make or break your business. How does venture capital? We have this one already, and we have this one already. Last one. I have a product I launched 3 months ago, and we haven't earned any funds yet. But people we spoke to the product like it and commented on its innovation. I need funds to marketing to get people to use it. What can I do to get a pre-seed? Yeah, like I think that that's a rough that's the space between two rounds, right? If I were an investor and this company gets pitched to me, it's like, hey, you have a product in the market, great. I'm considering investing, but I'm just going to stall this conversation for 3 weeks. And I'm not going to tell you, right? I'll be like, oh, yeah, sure. I'm interested. Let's talk in 3 weeks. And if your product hasn't moved anywhere in 3 weeks, then there's obviously something not working with the product, right? If you have launched 3 months ago and your product doesn't have any traction, something is off. Either you're not figuring out marketing, either your product isn't as sticky as you thought, or people aren't adopting it as quickly as you thought, because there's always guerrilla stuff that you can do to get customers that doesn't cost a lot of money. And if you haven't, and investors will have expected you to solve that by uh by the time you talk to them. Right. So it's a tough spot to be in with a product in the market and no traction. I would consider even rephrasing the story somewhat to say that you haven't really launched it. Yeah, because it's tough. Yeah, like traction is expected. The moment you launch, the conversation is no longer about, hey, this cool product that you're building. It's about, okay, who's using it, right? And that's a tough spot to be in between rounds. Okay, guys, I have to run now. I have to get to another meeting. But hope this was useful. Again, live stream on YouTube if you need it. I hope to see you on Slidebean. If you sign up for Slidebean Accelerate, I think my next group call is Monday. So there's a good chance I'll talk to you. Maybe I'll see some of you then. Have a good one. Bye.